Welcome to the latest edition of the Endeavour Exchange. Really excited, as always, to be here with Brant Butt, my business partner here at Endeavour Wealth Management. And so ready to go. Why don't we jump right into it? This is a good question that you actually brought up to me here, because this is something we get all the time from people. So I'm just going to jump right into this. So as a professional, in particular, doctor or a dentist.
That's who we get the question from.
That's who we get the question from. You're not a dentist or a doctor, but should you buy or lease your car? In particular, should you buy or lease your car in your corp is another part of that.
Yeah, and so when we look at it, there's obviously some corporate and personal tax considerations when we're looking at buying or leasing a car through a corporation, and whether or not it makes sense really all depends on the extent of what they call business usage. So are you using the car for business? And if it's used exclusively for business purposes, it obviously makes a lot of sense to use, corporate dollars before personal tax and whatnot. But, in the case of medical and dental corporations, a high level of business usage is actually quite hard to prove at the end of the day. And so if it's a corporate owned or leased vehicle and you use it for personal use, CRA then requires a corp to assign a taxable benefit. And when your personal use exceeds the business use, which it likely would in the case of an incorporated doctor or dentist, the actual tax benefit is nullified to begin with. So it doesn't really make a lot of sense. And so one of the things that's important to note here is that driving to and from work, that's not considered...
Doesn't count
as business usage. So eligible business kilometers include, they have three things: a drive from primary work to a secondary place of work. So, maybe there's two offices that you're moving back and forth between, business usage there. Drive from home to a secondary work location, that also counts as business usage. And then special trips to the primary workplace, but this would be for like an on-call professional, not necessarily if you're waking up and you're doing a 9 till 3 or a 9 till 4 shift, that is not counting. Now, people will try to kind of get around this by lots of times they want to list their primary or their principal residence or their home as their primary place of work, and then office as their secondary place of work. CRA, they know that. They're looking at it.
I mean, they're not dumb, despite what a lot of people might think. I mean, sometimes. But no, they're not dumb. They figured out a lot of these loopholes that people try to create.
Exactly. And unfortunately for most medical professionals, vehicles should be personally owned. Whether you finance or lease, however, usually depends on how long you want to own the car. So if you prefer to upgrade frequently, have a new car, if you want to avoid costly maintenance bills down the road, well then, leasing the car makes a lot of sense. Now, if you're one, and we know those people where you'll drive a car into the ground till that thing is barely moving, well, from a cost perspective, owning can be the better option. I say can because my experience with cars, they don't make cars like they used to anymore, and you get past a certain time frame, and I've always had pretty hefty maintenance bills with my pre-owned or owned cars, and so that's just a personal preference for me. I'm a leaser. I like that it's cost effective from a month-to-month cash flow perspective. I like that I don't have any headaches, and I like that I can take it back and get a new one.
It's kind of the idea, like you don't own depreciating assets, because cars typically, although more recently we've seen increases in values, that's a whole different story. But you don't own depreciating assets because why would you? So instead like do a lease, which is kind of like renting the depreciating asset. I like leasing personally. I mean, not only from a cash flow perspective in most cases, but I also like getting new cars. It's just something I like. I like the latest and greatest, and so every 4 to 5 years I get a new car and I enjoy it. But I know that's not the same for everybody. Like if you're not a car person, you look at life circumstances as well. And if your life is going to be changing in the next few years, like maybe you're having kids, or whatever, and so you're going to need a bigger vehicle, well, maybe doesn't make sense to go out and buy the vehicle that you're going to need to upgrade in a few years anyway. So you might as well lease it and then get another car in 3 years or something.
Totally. So to answer the question, medical professionals, dentists, incorporated dentists, you got to personally own it. If you're another business owner, well, it's going to come down to that business usage and something that you can obviously talk with your accountant or your advisor on and seeing if it at all makes sense. Question for you, Grant. We've seen a fair bit of news recently surrounding Facebook and their understanding and knowing of how toxic things like Instagram is and whatnot. And I wanted to pull up our first chart here, and what we're looking at here is the largest 10 publicly traded companies in the world, all the way from it's kind of every 5 years, all the way from 1980 up to 2015. The point of the list is to show that how much turnover there is in those top 10 names. Facebook quickly got themselves into that list after going public, and they've been there now, since they got on the list. But my question to you is, with everything going on, what is the future for Facebook?
Yeah, I mean, it's an interesting question, because I think there's a lot of questions to be asked of regulators and of the companies themselves around the role that like social media and these platforms play in society. Personally, I've said this a number of times around, like, I think that like social media platforms are incredibly powerful. I think they're incredibly useful tools and platforms, and from innovation perspective, I think there has been good that have come from it. I think, and there's been a lot of good that's come from it. But I almost think that we weren't ready for the power of these systems. And to your point, there's a lot of questions being asked around should there be more regulation about them, especially as it relates to how it's impacting kids and teenagers. Because you look at a platform like Instagram, for example, and a lot of us love Instagram, but it only really presents the upside of what people's lives are. Because nobody posts the bad stuff, really. It's always like the peaks. And so it creates this unrealistic expectation over what should my life be when all my friends are having all these great moments in their lives, or so on and so forth. Body shaming, body image, all of that stuff. So it is a really dangerous platform. Social media can be a very dangerous thing at the same time. And Facebook being the biggest, there's naturally it's the poster child for the whole discussion, right? So what's the future for Facebook? Well, I think that there's lots of things that are going to change in time, and I'm a firm believer that there should be probably more regulation around the social media platforms. But that being, and what that looks like, hey, that's not my job to figure out, thankfully. But I do think that there should be more regulation around it. But I don't think Facebook's going away anytime soon. Certainly, I think there's a lot to like about Facebook. I mean, I think from an investment perspective, I think it's a company that is just starting to, as big as they are, as you mentioned, they're the top 10 in the world now. I think they're just starting to tap into the true profitability of what their platform can create. I think there's a lot of opportunities in things like augmented reality, which they are certainly a leader in. I think augmented reality is huge.
Yeah.
I think we're going to see that in everywhere. You're going to see it in glasses, you're going to see it in your car windshield, you're going to see it in
gaming. They have eyes on gaming as well.
You name it, right? So there's so many applications. So I think Facebook has barely scraped the surface in terms of what they're going to be able to do from a profitability perspective, and even advertising and things like that. It's huge. But are there going to be speed bumps along the way? Absolutely. There should be, frankly. So there's going to be more regulation. Will they be in the top 10 forever? Well, based on the chart that we pointed out,
the odds are against them.
The odds are against them.
Now, I will say, so we got Google in there in 2010, kind of bottom of the list. They're near the top in 2015. If there's a company, the Googles, the Facebooks of the world, these tech businesses, I think these are some of the businesses that we could see. I don't think they'll always be on the top for eternity.
Yeah.
But if there's a business that has the power to stay there longer than any other business on this list, maybe other than Berkshire Hathaway and Microsoft there as well, but these tech businesses, I think there's some pretty significant moats built around them and some pretty significant staying.
Yeah, you see Microsoft is a good example because they've been in there, since 1995.
Oh yeah, 2000. 95. Yeah,
so 1995. I mean, it's a high growth business. Facebook's a high growth business, as is Apple, Google now, Alphabet. So these are really high growth businesses. So yeah, I wouldn't bet against it. I wouldn't bet it would be there.
Yeah.
But at the end of the day, it doesn't matter if it's in the top 10. No, I don't really care about that so much. It's just a stat. I think they're a really high quality company, but I do think there's some lines being crossed as it relates to ethics. Not to say that they're like doing anything illegal or anything like that. I think there's questions society needs to ask around this stuff. So that's going to happen, and that'll certainly be a speed bump along the way.
Absolutely.
Okay, so we're getting a lot of questions about this as well.
Yeah,
and
lots of news coming out.
I just got one today. So, could China's real estate bubble produce a 2008 type of event? And again, it's kind of creating some shockwaves through the markets right now. So, what do you think on that?
We'll kind of set the stage here. It's one of the biggest financial worries China has right now, with a fear that it can potentially spread outside of the borders. And if you've been following, financial news, you would have heard about this company Evergrande, which is one of the biggest Chinese real estate developers. Well, they're $300 billion in debt, which is an enormous amount, and they're expected. And I believe I saw something recently where they have actually started to default on some of their payments and loans. Because of this, investors around the world are essentially holding their breath to see if the government will step in and whether this is a Lehman Brothers type scenario. And we saw markets earlier this week get some jitters. They've since shook a lot of that off. But to put this into perspective of how big Evergrande is, $300 billion is about 2% of GDP in China there. And, worst case scenario, the stress spreads across, the financial system. You could possibly see some sort of credit crunch. It could be China's kind of Lehman moment, becoming something similar to what we saw in 2008.
Sure.
If any of this were to transpire, we're talking about a real estate crash in China, which could lead to unemployment, lower wages, and ultimately recession. With that said, they have a lot of tools to prevent that, of course, and actually Wall Street right now believes that Beijing is there and will, if there was a problem, that they would be stepping in. And so, the question, and I don't think any of us can say for certain or not, but some pretty smart minds have been weighing in on the topic, including investor and author Ray Dalio, who's an expert in credit crises. The question becomes, are they too big to fail? I wanted to pull up just another chart here as well, just to show you. So this is a second chart. You'll see on the left-hand side the debt accumulation of Evergrande and how quickly that ramped up, and it's actually almost doubled from there. So is it going to be a Lehman Brothers, a 2008 type event?
Yeah.
Well, just to put this into perspective, this was not unexpected. Real estate companies in China were borrowing excessive amounts over the last decade or so. And what happens is it turns into the situation where these highly indebted companies, they need to continue to grow in order to service that debt. And we'll see on the second chart there, the revenue from this company, growing massively, yet the net income has really done nothing. And they got to keep growing in order to be able to pay those bills. And in August of 2020, the Chinese government began implementing, and as I mentioned, this is not unexpected. They began implementing what they call the 3 redline policies, which are checks and balances on real estate developers meant to control housing prices and manage the markets and how cyclical they are. And so it's essentially forced deleveraging. So they would have known that by implementing these policies that there were essentially going to be businesses caught in the crosshairs of that. And so they were aware, and it's naive to think that there's no plan to deal with this.
Sure.
So are they too big to fail? Well, according to Ray Dalio, his belief is that this problem, and again, he is if there's any person that, when we're talking credit crisis, this is the person that I would be paying close attention to their thoughts on it. And, he believes it's very manageable. Investors will get stung, like the investors of these businesses will get stung, but the system will remain intact. In the case of the Lehman Brothers in the 2008 financial crisis, the Treasury and the Fed took time to come to the table and deal with the problem, so contagion was able to spread. However, it did get managed. Dalio says it'll get managed the exact same way just the Chinese government has the tools to deal with it right away.
The big difference is, like, when we get into all the politics in North America, and we see it here in Canada as well. Like, I mean, there's often lots of debates. You don't get as much of that in China. They just, I mean, it's like when you got a solution, like, it just,
when there's a crisis,
Yeah.
And I know we have some of these debates in the office here. When there's a crisis, having that top down
yeah,
versus that in North America, we're very bottom up. It's a
Yeah.
democratic process, and there's a political, there's decisions being made that have political effects to people's, jobs.
Yeah.
And, in China, well, they're top down and they can just deal with it. And so, at the end of the day, the basic mechanics, according to Dalio, is all the debt that's owed, it's in their own currency, and that's the key differentiating factor when we read about Argentinian debt crises versus the U.S. 2008 crisis.
Yeah.
When the debt is in your own currency, it's something that can be managed. Now, doesn't matter to, like, we're talking about it, but doesn't even matter to investors anyway. I would say, in the short term, obviously, yes, you get some fluctuations because of these type of events. But if you stick to good principles, if you avoid overly indebted businesses, you will be fine. It doesn't mean that these businesses aren't affected by a credit crisis or an economic crisis. When the economy is suffering, businesses that serve the economy will suffer as well. But if they're strong businesses and they're good businesses, they will withstand those crises.
Totally. I mean, it's this, we were talking about this earlier. It's like, even if you knew the financial crisis, like, there's no way to know when it's going to happen, right? So even if you knew if something was coming, you just didn't know when, which is, frankly, it's always the case. There is always something coming down the road. How would you do things differently? Well, I mean, again, sticking to your principles, sticking to a disciplined investment approach has proven to be the winner along the way. And then rebalancing into, like, good quality businesses or whatever, or other assets when it became attractive. So rebalancing into that, buying at attractive prices, that's how you win in these scenarios.
The best investors in the world, like, yes, we get the investors, the Michael Burrys of the world who became famous betting against a single event, but the true best investors of the world, the Warren Buffetts, the Dalios, leading into the financial crisis, they weren't selling businesses. They were making sure that their portfolio was positioned in a way that it could withstand whatever was coming down the road, that they saw there were certain events going on, and they didn't want to get caught.
And they would have dry powder to deploy.
Exactly. Yeah. So own good businesses, own quality, hold these businesses. Don't go trying to predict a financial crisis around the corner and making investment decisions based upon an article that you read online.
Yeah.
So I guess the answer is we don't know what will come of it, but again, you don't need to know.
If the newspaper's predicting it, odds are it's not going to happen
exactly.
usually, but yeah.
This has been in the news lots. Maybe it's just us because we're in the industry, but there's been some changes in the investment world, specifically a lot of the bank branches around the world, around Canada, have been making some changes. So Grant, maybe you could talk a little bit about what the changes the big banks have made and what that means to essentially their customers.
Yeah, so I'll just speak, because this is public knowledge now. So RBC, TD, and CIBC have all come out and said that they will, through their retail bank branches, will only be offering in-house products going forward. And this is all part of what we call the KYP, or the Know Your Product mandates and rules that are coming into place starting early next year. And so the reasoning for this, or in their words, the reason why they're doing this is because they believe that it will help to protect investors that are coming into their branches, their clients, their customers. It'll protect them because their advisors in the branches will know those products that much better, and therefore you won't be at risk of getting a product that they don't know that well. So that's kind of the gist of it. Mm-hmm. Is that's what's going on, is that the banks, those three banks in particular, have come out and said that's what they're going to do. No, I mean, I have my own opinions on this, obviously, because in my mind, really, this is, I mean, I think this is a move to reduce liability. I'm not so sure that it's in the best interest of the client. In my opinion, having more options available to people as investors is always better. Now, of course, it's always how you use those options that makes the difference. But, it does put a limiting factor, certainly. There's no denying that. That's a fact. It puts a limiting factor on the options available to clients and customers that go into these bank branches. That's where they're getting their advice from. You have to start a question, is the
Well,
advice biased towards
I
in-house
was going to
product?
say,
Because
at
it has to be.
at the same time, what the alternative is a product that boosts the bank's profitability immensely. Like these are
Right.
highly profitable. The asset management businesses that the banks own are highly profitable
Right.
businesses.
Right, absolutely. I mean, and truthfully, that's where a large like they have higher margins on that type of business, generally speaking. So, yeah, I mean, I really question whether or not this is in the best interest of the individual investors or the families. And in my mind, if the choice is to limit your product offering and limit your options to your clients, or ensuring that your advisors, your staff have the appropriate amount of training in order to advise those people appropriately to assess third-party products so that you can advise them appropriately and make sure they always have the best. Why not choose the latter? Why would you like? In my mind, that's always the option you should choose: is make sure you have good people that are trained well to do the job properly and provide the best service and experience to your clients. That to me is a no-brainer. So, anyway, it's an interesting move. Again, these are really good institutions. Like from an investment perspective, we've owned them all at different times.
Yep.
But at the same time, do I think that this is in the best interest of their clients and their customers? 100% no. I think that having more options is always a better thing.
And I'm not necessarily mad about it for an independent like ourselves.
Yeah.
I mean, it means opportunity for us where we run an independent business with no bias to any single product, and so it's unfortunate for the customers of the bank, but at the same time, there's opportunity, and you don't have to stay with your bank. So
No, I mean, the good point is you have options available to you, and we will continue to always believe that unbiased advice that's agnostic of manufacturing is the best advice. Like as you know, here we're not tied to any one product lineup, which is in our mind the best way to do it, because now we can choose the best. We can go to the marketplace and choose that. A lot of Canadians have now been limited on that option, and that's unfortunate in my mind. So I really question about whether this is taking the industry forward. In my mind, it's taking the industry backwards. But the good news is there's options out there for people that want those options available to them. So
perfect segue into, thanks for joining us.
Yeah.
Check us out at endeavourwealth.ca. We are on Facebook, Instagram, LinkedIn. If you have any questions, our contact information can be found on our website there. You can email any of the advisors here, and we'd be glad to field those questions and bring them to the next episode of the Endeavour Exchange. So with that, thanks.
Thanks very much.